Eric Hunsader, founder of Nanex, which is a market data and analytics firm, also at CNBC's headquarters. Edgar Perez joins us. He is the author of Speed Traders. Gentlemen, welcome. Eric, let's start with you. We just heard from the Berkshire Hathaway vice chairman. He was talking about high-frequency trading, calling it legalized front-running. Do we need high-frequency trading? Is it a good thing for the markets?
It is a good thing for the markets as long as they follow the same rules as everyone else.
And why wouldn't they?
Why wouldn't they?
Follow the same rules. I mean, they're supposed to, so why is it that we keep talking about whether it'll happen again?
And that's a great question, and one I ask often. I would like the answer to that.
Edgar, what are your initial thoughts? Which perspective are you coming from?
Well, if you take a look at my book, The Speed Traders, what I try to show there is that high frequency is really the application of technology into trading, as there are billions of shares traded every day in the New York Stock Exchange or any other exchange. Obviously, you need computers to participate into that. So obviously, trading has been, of course, experienced the application of technology there, and that's something that will continue. I don't think that's something that's going to stop, and it will be continuing on that.
Is it fair to blame the traders and the computers, though, for the glitches time and time again, or is it the actual system that needs to change, or the regulation that needs to change, Edgar?
Well, what I think is that we are definitely focusing on glitches at the moment, but if you look at history, glitches have existed forever. Look at 1929, that was already a crash there, and there was Black Monday more than 20 years ago as well. So these mini crashes, accidents, trading incidents always happen. I think there's a strong focus right now on these type of incidents thanks to Knight Capital, thanks to the flash crash. But to be honest with you, computers actually are not part of the reason. And most people will agree that indeed there's a human component behind those items, maybe some fear in the markets that lead to these incidents, people running away through the door at the same time, but not produced exactly for computers.
Eric, I know that you argue that electronic trading brings down costs, but it also brings down ethics. Why do the two necessarily have to go hand in hand?
Well, the thing is, these flash crashes that we've been having really haven't existed before 2006. Yes, the market's always crashed, and it always will have major events, but never events that, like, for example, with Twitter, where the whole market falls apart on 12 words.
It's just, I was covering the one-year anniversary, and I was in France at an event where we were talking about whether or not it could happen again. And I spoke to somebody who was very much in the middle of the flash crash when it did happen. And he said, look, it doesn't matter how many systems you put in place, it could still happen again, because as long as it's computer-driven, glitches happen. It's part of our computer-driven life, unfortunately, that we need to get used to. So it's more about figuring out how do we deal with the glitches when they happen versus assuming that we can prevent them altogether, Eric.
Oh, absolutely. But we could go a long way to preventing them if the regulations were simply evenly enforced.
Eric, do you think, Edgar, do you think that high-frequency trading kills liquidity?
I wouldn't say that. Let me take on the following point that you mentioned a few minutes ago about these incidents. It's not only computers that are the reason of these issues. If you look at the incident of Knight Capital, for instance, we talk about that happened August last year. It was actually a human error in the installation of a software piece. So it wasn't really a technology issue there or a trading mistake there. It was something that was a human, and that some type of incidents always happened in the past and will continue happening there. So Eric's mentioned, I think regulation has to play an important role. Regulation play a role in developing high-frequency trading by allowing competition, allowing new exchanges to participate, new players to enter into the markets, to technology to play a bigger role there. And I think that's what needs to continue. In the same way the regulation plays a role in creating these new developments, regulation will also need to be used in monitoring these trades, creating these kill switches, so we're able to stop incidents from happening again.
Gentlemen, thank you very much. Edgar Perez, author of Speed Traders. Eric, thank you to you as well. Eric Hunsader, the founder of Nanex.